Hello and welcome after this short break that we have had together. So now we are ready for our next keynote speaker, Javier Hernani Borzaco, Head of Securities Services at SIX, Chief Executive Officer of BME. Welcome, Javier. The floor is yours.
Thank you very much, Anna. I'm very glad to be here, and thank you for attending the Congress, and thank you to EXA for inviting me to participate. Post-trade in this world, I think, has been going through a period of unprecedented change, very clearly influenced by regulation, clearly influenced by technology. I think there has been quite of a change in paradigm in the way we do business all over across markets these years, and to some extent the reforms that I think have been taking place these years have redesigned the whole setup. No? Especially everything that has to do with the competitive landscape that we are all facing. So regulation is a key element that we will go into more detail now, and also the digitalization processes in which we are now living and starting to test and see how we can actually go into more efficient models around the digitalization process. I think these years have been a cocktail of very different things: the pandemic, the IT revolution, the volatility that we've seen, the war now, the increase in regulation, and then on top of this, everything that has to do with crypto assets and cryptocurrencies, which I think is another very clear source of change and of challenge to this industry. So very complex years, I think a very important change going forward that is now in the making. It's also boiling, and we obviously need to read very well these elements in trying to anticipate and understand how the game is going to be played from now on. If you go to the first slide, the next one, please. Yes, this one. Thank you. I mean, regulation is all around. I can still remember the song "Love is All Around." I mean, regulation is all around like that, in the sense that we've been living these years through a array of regulation that has covered all bits and pieces of the value chain. Also, obviously, post-trade extremely involved into that. I think the big effort we've done these years, obviously, is to try to adapt to the new regulation, and also to understand the dependencies that the different pieces of the regulation have with each other. I think this is one of the elements of biggest complexity these years, is to do all these adaptations at the same time, make them work all together in a way that is harmonious and possible for our businesses. No? From the point of view of settlement and everything we've seen in the last year, and so I think the SRDR has been a positive development. I think it was needed that we went to a regime of discipline in the settlement part, because obviously experiences we lived in the history of unsettled trades on the specific companies, especially in the small companies, I think can be of a lot of a value destruction in the market, and to have a tool like this, I think will be probably in the long run is going to be positive. Also, not to forget that finally the project to impose mandatory buy-ins was dropped, and therefore I think the destabilization on liquidity that might have happened coming from this regulation was stopped. What do we have now from now on in terms of regulation? Obviously, there will continue to be different debates in which we are all engaged. The debate on T+1, T+2, in the case of Europe, going from T+2 to T+1, still remains to be seen whether there is a real appetite behind doing this effort. I think there are obviously arguments in favor and against. I think the business case needs to be proven, in my opinion, to this date. To a large extent, we knew what meant to come from longer periods to shorter periods and come to T+2. I'm not sure we are actually taking the system to the limit of its capacities of doing a fair and stable settlement. It might be, and this is just my opinion, it might be that the effort that we are planning to do in terms of shortening the settlement cycle will be coincidental with the digitalization of assets, with the digitalization of processes, and might be that to do those two things in parallel might be an effort that is maybe not worthwhile. Obviously, the digitalization of processes promises, according to all proofs of concept, and we've done, and the ones, for example, we've done in 6, promises a very, obviously, very efficient and short and instant settlement. This needs to be obviously proven at the very big volumes. But the question is, do we do this effort to T+1 now at the same time we do digital, or we choose which one is the best road to bring efficiency and less risk into the settlement processes? I think this is probably one of the biggest debates. We go to the next slide. Into the digital assets environment, if I begin by trying to draw a little bit of the framework in which we see in this moment the cryptocurrencies, for example, starting by that, the cryptocurrency situation, I think these three graphs are very telling, are very clear. First of all, the market cap that we already see in terms of the total cryptocurrency interest is above 2.3 trillion, which is already a very important number. This is not obviously anymore an experiment, and this takes me directly to the next point, which is the need to regulate this activity as soon as possible, because this is not anymore a small thing that is happening somewhere with some people trying to diversify into other investments. It's a big reality that is bringing clearly a risk and has to be tackled also from the point of view of regulation. It is a very widely distributed asset in the sense that it's not only some very big investors that are doing big amounts. Is the fact that out of, according to Fidelity Digital Assets, half of investors globally have already exposure to digital assets, 52% according to this study, while 9 in 10 said that they would find digital assets to be attractive. This is clearly means that the appetite for crypto is in the ascent. That is not anymore, let's say, a limited effect. The growth is very important, as you can see also in the right-hand graph, in which the total market cap of Bitcoin goes beyond very established and important commodities like palladium or platinum. No? So this you can find different references to different types of assets. The reality is that cryptocurrencies are already a very important asset, and they are not a risk-free asset. Is clearly, as we have already seen in the latest developments, they are bound to increase the risk in the portfolios and still have to prove from a macroeconomic point of view how they act as a hedge for risk, for the evolution of risk, for interest rate risk. At the same time, how they act as a hedge to rising inflation. This, in my opinion, needs to be still proven in terms of what is the macroeconomic contribution of cryptocurrencies to the overall investor portfolio situation. Same time, I also want to mention the fact that on ESG standards, cryptocurrencies are starting to be questioned in terms of what is the impact that they have on sustainability, in terms of the intensity of the energy needed to mine and make those cryptocurrencies possible. They have a potential to be systemically important, and again, the sooner we get into this regulation, clearly the better. If we go to the next slide, what is happening all over the world? Some countries have directly banned the introduction of cryptocurrencies. Others, like the European Union, have taken a more nuanced approach, where the MiCA environment of regulation is actually being discussed and in the process of being applied. I think that the relevant, the recent Terra Luna debacle, where people lost collectively roughly 600 billion in value only in the past month, will probably trigger the need to actually put MiCA and the rest of the regulation in place as soon as possible. I think that is really needed. If we go to the next slide, obviously, digital assets are not only cryptocurrencies and stable coins. We have a very interesting variety of assets, from the exotic assets to more traditional assets. The possibility to use digital technology in terms of tokenization of assets that are not now in the offering of products because they are too expensive to reach by the public, by the average investor. I think is a clear opportunity to provide for the industry to provide with new assets, with the accessibility and democratization of those assets to a wider public of investors. Obviously, in years like this, in which we have an interest rate risk that is clearly there, inflationary pressures, to be able to provide, on a more democratic level, assets that are not so correlated to this kind of negative effects to the wider public, I think is a golden opportunity for this technology to step in and basically fill the needs of investors that want to diversify and obviously get out of risks in the market that sometimes only with obviously equity, with normal derivatives, bonds, fixed income is not possible. So I think the digital part of this kind of crypto assets via tokens, I think can be extremely interesting and value creating for the industry. We go to the next slide. Obviously, if the digital assets continue to grow and we go into the world in which more and more assets are tokens or digitalized, obviously the need for custody in this environment is ever growing. As you can see in these graphs, the evolution of the projections on today's level of digital assets, I think are very important. There's a 154% increase to Q1 23 from Q1 21, which basically shows the need to develop the systems, this offering, and also the need to do it as soon as possible. We can see that the sector has increased the number of offerings 6 times in the past 6 years. And if you see in the right part of the slide how traditional players in custody have been stepping into these services together with the technology companies that are actually bringing in the new technologies needed to be able to go through this. I think in any case, this is an effort and a trend that will continue to be very strong. I don't think there's going to be an immediate or a sudden big bang adoption of the digital assets against let's say the legacy situation. But this substitution will not happen overnight. But it's clear that we need to align our budgets, our efforts, and our possibilities to do that as soon as possible, because this is, in my opinion, coming, because the reasons behind it, I think, are very powerful. Actually, from the 6th group, as you know, we already have one initiative, which is much more than an initiative already, because it's a fully licensed exchange in Switzerland, according to FINMA rules, which deals with already from the DLT environment, deals with listing, trading, settlement, custody, offering already a full support to the whole digital situation. So the future is, I think, is digital. And to finalize, let me just give you some very small summary. First of all, yes to early regulation. I think we need regulation to be sure the market is providing the right assets in the right safety. Yes to evolution. Yes to go into more digital. Yes into new assets and including these possibilities for investors, and everything together combined to provide investor protection and make it compatible with innovation and efficiency, which is obviously the name of the game in all industries, including ours. So thank you very much for your attention. This is what I wanted to tell you today. Thank you.
Thank you very much, Javier. That has been a very interesting speech. Much appreciated. We have a question from the audience from Andrea Tranquillini, who is asking what should be avoided in regulation supporting digital assets adoption. Would you have a quick take on it before we jump into our next panel?
I think what is very important is to learn from the story, from the history and the fact that we've been in difficult situations in the past, which had to do with market infrastructure as well and how markets did operate in the past. And to me, one of the key things to provide this safety and to provide this transparency is basically that we use the unbundling of that securities post-trade went through after the financial crisis, which is basically to separate all activities in the value chain. One thing is trading, another thing is clearing, another thing is settlement and custody. So the fact that in this construct today, without the application of the regulation, we have companies that do everything in the same time, in the same construct, I think is a mistake. It's okay that we don't kill, nobody wants to kill innovation. We need to start probably with softer rules so that we see what is the value of that and whether or not there is interest behind. But once the size is enough, and I think what I wanted to transmit in my presentation is that I think everybody agrees already that the size of this element is really big in this moment. Is really the moment to apply the good old lessons from the past, the separation of responsibilities, the separation of supervision, so that everybody can trade volatility, but trade on a safe basis. So we don't, the companies and the savings of people don't disappear all of a sudden under any problem like Luna or Terra.
Thank you very much, Javier. So that's indeed extremely useful to know that despite the fact that we are still using the new market, the new asset type, but we're still playing our fundamental role, which is to ensure the safety and stability of financial markets, first of all. I'm sure we'll be learning many more lessons indeed from your very beautiful example that you are now undertaking in Switzerland. Thank you very much for this keynote speech, and looking forward indeed to the panelists of your group to be present at this conference and developing further on some of the thoughts upon which you have touched in your keynote speech. Thank you.
Thank you very much. Thank you to everyone.
Now we are set well in order to continue with our next panel. The next panel, which will be touching upon another fundamental role of the CSDs, which is the facilitation of the cross-border investment flows and attracting of foreign investors from one market to another, and thereby having the real economy to grow and to blossom. So we are ready now to hear the panel that will be moderated by Philip Brown, CEO of Clearstream Holding AG. Philip, welcome to this conference. Over to you.
Thank you. Thank you, Anna. And I hope everyone can hear me clearly. My line's been a little bit laggy. So if you can give me a thumbs up and let me know that you can hear me, that would be great. Brilliant. Right, let's hope it stays that way. So welcome, everybody. Delighted to have you all here with us today. I think we're going to talk about a very interesting topic, which is what can we do as CSDs to help economic development and foster the cross-border movement of capital and investment. My name's Phil Brown. I'm the CEO of Clearstream Holding. I've been with the company now about 17 years, and prior to that, I worked in a number of custodians. And I'm joined by a very, very illustrious panel today, which I will now introduce to you. First up, Attila Toth is the principal in the Equity and Capital Markets Infrastructure and Capital Markets Development team at the EBRD. Welcome, Attila.
Hello, welcome.
Secondly, Kevin Sampson, joining us from Toronto, who's the president of CDS, the Canadian CSD. Welcome, Kevin.
Thanks, Phil. Glad to be here.
Sudeep Chatterjee is head of global capital markets at Euroclear. Welcome, Sudeep.
Hello, glad to be here.
Ozkan İlkay Kızıltoprak is the executive vice president of MKK, the Turkish CSD. Welcome, Ozkan.
Hello, everybody.
And finally, certainly not least, Sarah Taranway, who's the CEO of the Securities Depository Center of Jordan.
Hi, everyone. Nice to be with you.
So we've got a really nice, well-mixed panel today, a variety of regions of the world represented and different kinds of institutions. I'm sure it's going to be a very interesting discussion that we have today. And what we're really here to talk about today is how CSDs are not just about custody and settlement or collateral management, but what I think is the core function of a CSD, which is to help investors meet those who have investments to make, to meet places that need investment in a very safe, controlled, efficient system. We are financial market infrastructures, and in that sense, we're guardians of asset safety, market safety, and security. And I think this security angle is really critical to the role of CSDs, especially as we move into this digital world that we're now talking about moving into it, as Javier was mentioning on his keynote. So we help direct capital to where it's needed, and this affects real people in real jobs in the real economy. And I think it's one of the unsung benefits that we bring as organizations. So everybody on this panel today has some of that function in their DNA. I think we can genuinely make a real world difference. I liked Anna's opening this morning. She was talking about the geopolitics, and I think our role in keeping the world connected is really critical. And in doing so, we can help create growth, drive value, but also I genuinely believe we can help make the world a better and safer place. But to do so effectively and to use this opportunity to drive change in the world, it's critically important that we all understand the trends that are facing our industry and the wider world and prepare our companies for these. So with that in mind, I'm thinking about the fact that local markets everywhere in the world are competing to attract portfolio investments into their countries. I think financial market infrastructures can play a really important role in creating a well-functioning trading ecosystem, and in the end, determining which markets the growing number of international investors pick and choose to invest in. So I want to talk quickly to the CSD members here about what does your CSD do to support your local economy. And Ozkan, if I could talk to you first and ask you just for your, for your thoughts on this question of your role in fostering the economic growth of Turkey.
Thank you, Flip. As you know, the ever increasing levels of the cross-border securities transactions are impacting the local capital markets in a positive manner. The investors that are seeking extra returns came into our stock market. I'm going to share a few data to understand how MKK supports the Turkish economy. MKK safekeeps over $2015 billion securities asset, $13 billion government debts, $25 billion mutual funds, $9 billion corporate bonds, $16 billion structured bonds. Also, MKK holds over 55 million individual investor accounts. Over 7,000 members have integration with MKK directly. So MKK has a big responsibility to protect financial assets and plays crucial role to interact with the market participant within the financial market infrastructure. All in all, CSD matter in this respect because of the following reasoning. The one, they hold the golden source of data on which the investment decisions are made. The second one, in the most of the countries, including Turkey, CSD have a legal obligation to operate the settlement system safely and effectively. This should be the number one priority for CSD. In Turkey, CSD has always been to cater the local market needs of those foreign investor and support our custodian bank members, working with them closely to our groups and custodian and provide the service to foreign investor. Due to our plan to establish Istanbul Financial Center and Global Hub, we have an extra focus on new projects to establish more efficient integration of our markets infrastructure to the regional and global infrastructure. Cross-border trading is only effective through the smooth functional links between clearing and settlement system. So we are concentrating our efforts to enable foreign investors to invest in financial instruments traded in the Turkish market. Above all, we want to position Turkey as a pro-innovation jurisdiction in financial services. MKK, through its Research and Development Center, R&D, is continuously working on developing systems and platforms to make our markets attractive to invest. MKK is the first company within the capital markets in Turkey receive R&D license. It develops in-house solutions such as electronic general meeting. We mark these solutions internationally and currently have an ongoing collaboration with a couple of the foreign CSD in terms of integrating our solutions to their capital markets. Besides providing core CSD services to other functions to our markets, we also add value to our economy via exporting the technology and know-how that we develop in-house. MKK is among the most developed, equipped CSD that transform themselves as a fintech company in addition to the legacy roles. We can do our best to increase the flow of foreign investors to our markets by implementing a safe, robust, technologically first-in-class market infrastructure. Thank you, Philip.
Thanks, Özkan. And I'm going to come back to this question of digital innovation a bit later with some of the other panelists. But Sarah, why don't I hand over to you and let you give your reflections on what your role is in the Jordanian market in this respect?
Sure, of course. Thank you, Phil. Well, in any capital market, I believe that the CSD is always the first point of contact to foreign investors. It's like the backbone for the investment because the first process is to get identified in the CSD system, regardless of that system, how it works. Of course, the more you facilitate the process for the investors, the more flexible it is, the more easier for the foreign investors to get into the capital market. Of course, the due diligence process, the information, all the access that would come either through any of the three channels that are considered the bridges for foreign investors to come into any market. Well, these three are mainly, generally speaking, of course, are mainly the local agents, the sub-custody arrangements. And this is where such market participants would always need to have a very close relationship with the CSD in order to get further information, further insight, perform the due diligence that is required from the foreign investors' side to be able to get into the market and to exit easily from the market as well. The other aspect for providing, or basically for access for foreign investors, would be the CSD to CSD links. However, this is not usually a very feasible process or very easy process because many jurisdictions vary in the legal framework and in the setup, whether regarding the clearance and settlement processes, the settlement cycle period, the whole operational and legal infrastructure would vary sometimes from a jurisdiction to another. So that would not be considered a most favorable way to open up markets for foreign investors. However, the last one, which is considered from my point of view, one of the most effective ones, is the linkages to ICSDs. Well, why is that? Because it's a most broader one, and it allows for further risk management and further safer environment for foreign investors. They tend to look at it as a very effective means to enter markets. However, as well, I have to say that this is not always a feasible option. Why? Because ICSDs themselves, they have their own requirements to enter into any market, and they tend to like to, or basically to link with central banks usually, and they have their interest. I think Sadiq should shed some light here. They have interest on more interest on the government debt instruments or the bonds, generally speaking. Of course, if the CSD is not the registrar for government bonds, which is sometimes the case, such as the CSD of Jordan, we are only the registrar for the equities. However, the government bonds is held with the Central Bank of Jordan. This is where you need to have some sort of cooperation and collaboration between these two entities as being registrars, and then have some sort of linkage to an ICSD, so it would open up your market to foreign investors.
Sarah, that's really interesting, and I'm moderating, so I'm going to sit myself outside of the discussion. But we do have Sudip here, and it's a perfect segue into him, and maybe sort of you can say something about, respond to Sarah's comment about the kind of the way that ICSDs will enter a new market, but also talk a little bit about some of the work that you've been doing at Euroclear and what the ICSDs can do to try and facilitate this cross-border investing.
Yeah, thank you. Yeah, government bonds. Why do we like government bonds so much? It's not that ICSDs like government bonds or ICSDs don't work with the CSDs which hold equities. ICSDs work whatever their investors behind, their participants behind them wishes them to work on. And the typical way that the investors wishes is the following. So the way that a market accesses the bond market is the following. First of all, whenever we see emerging and frontier markets going to the international markets, it's in a step-by-step process. First of all, the emerging markets, they go to the international markets through the Eurobond route or the foreign bonds route. So, for example, the government goes to the Eurobonds or the US Reg S 144A kind of a structure. And the issue over there, so what happens is that the legal framework that is there is a foreign legal framework, which is very much acceptable for the international investors. And then that is bought by the international investors because they think that, okay, this is also held in foreign banks, like the common depositories, which we call, and or in DTCC, and then it is in the, let's say, a common law, say English law, US law, whatever it is, and so my securities are protected, and that's what the international investors think. So that is what they first like to buy in, because then it is a risk that they are taking only on the issuer, and that's why that's a path that the issuers follow. And then the second thing that they do is that this issuance that they have is an issuance typically in a hard currency that they do, US dollars, euros, GBP, Japanese yen, whatever it is. The second step that they take is an issuance in the same form, let's say a Eurobond structure, a global bond structure, but they issue it in a local currency, denominated in a local currency. So let's say they will denominate in a local currency. The settlement will still happen in whatever currency it will be there, but the denomination will be in a local currency. The laws are still the same, the common laws, etc., US laws. So that is what happens. And then what happens is that the international investors, they see already that, okay, I can trust the issuer to a certain extent. Okay, can I take a risk on the currency now? So that's the second step that we see. And then if the investors are okay with the currency and taking the risk on the issuer, then as a third step, they go to the local market. So they delve into the local market laws and actually taking the local market laws into consideration. But then the thing is that what they want us to do is, to the ICSDs, they tell us that, okay, when you are going, the first thing that we want to take a risk on is the sovereigns, because the sovereigns is the most risk-free entity that is there. The sovereigns, they can actually, if they run out of money, they can tell the central bank to print the currency. Sovereigns, it's a rare thing that they can be bankrupt in their own currency. So that's the way that they want to put the risk in, and which is why we first like to talk with the sovereigns and open the link. When we open the link, we open the link with the sovereign bonds. It's not that we like to do that, and we don't like to work with equity CSDs. We always like to work with equity CSDs, but it is a kind of a requirement from the institutional international investors to first work with the sovereigns, because it's less risky than working with let's say corporates who are issuing equities, because corporates are by definition much more risky than the sovereigns. Now, slowly then it comes to the corporates. After the sovereigns are already there, then the sovereign, the point is that once the sovereign yield curve is established, then it is dependent on that based on that yield curve is always that yield curve plus the delta that you add on the corporates, and then the corporate yield curve is made, and then based on that there will be the equities which is being created, and then you see what is it coming out. And often what happens is that's why there are various instruments which are there, like the depository receipts, which are created in these kind of markets by various agent banks, which take the risk in these markets, and they buy those things. Custodian banks buy those equities in the market. They take it to the London market or the US market, and they issue on the back of that, they issue the depository receipts on the UK laws or common laws or the US laws, and they sell it to the institutional investors, which they buy, because then that is actually in a law which is much, much better, which they feel much more safe in. Which is another mechanism which works, because then those depository receipts are actually held in the ICSDs, and they are bought by the investors in the ICSDs, because they are actually, depending on whether they are GDRs or ADRs, they are actually within those kind of common laws or US laws. So there are these kind of instruments which can then help, and which helps actually a lot of different markets. So I'll pause over there just to have this discussion ongoing. I don't want to monopolize this, but I give it back to Phil probably to continue the discussion.
Yeah, thanks, Sudeep. And I think what you've made clear is that the market's pretty innovative around creating these channels for investors to find ways into new markets, and whether that's by DRs or Eurobonds or a link or whatever it might be. And Kevin, one of the things that we have seen in Canada is a pretty heavily used and well-trodden link between the Canadian market and the US market. Now I'm going to go back to Sarah as well in a moment and talk about something similar that may work in the Middle East. But Kevin, maybe you could say something about that, because it's a slightly different channel to what we might see in other regions of the world, and talk a little bit about what was built and what it does and why you think it's important.
Yeah, no, thanks, Phil. Great point. And I think tying it back to kind of the question around, how do you facilitate, how does a CSD facilitate increased investment within their own jurisdiction, or facilitating growth in the economy and the success of its local investors? To me, a key part is the movement of capital, right? You want to be able to facilitate and have fairly frictionless movement of capital in and out of your country, and that enhances liquidity facilitation within the market. It allows more effective position management, back office record keeping, and so on and so forth. So, as you mentioned, we're fortunate to have one of the most robust and active international custody, clearing, settlement, intermarket linkage with, arguably the single largest economy in the world. Now, we do have the advantage from proximity. We share a significant border with the US, and so it's an advantage there. But we have a relationship with DTCC and NSCC, where we have an intermarket linkage between the two jurisdictions that allows for, it facilitates the transfer of positions across the border within the respective CSDs in the jurisdiction. It enables access for Canadian participants, efficient, low cost access to the Canadian or to the US market by Canadian local participants, and access to the custody, clearing, and settlement services of the US. And so I think there's two aspects to this linkage that's extremely important. One is what I would refer to northbound, right? Facilitating investment from the US into Canada. And I can't overstate enough the advantages to our secondary market and the liquidity that facilitates. For US participants and US participants that are serving local US investors or international investors through New York or Chicago, for example, for them to be able to effectively move positions from their US custody account up to Canada, and then leverage those positions to be able to trade in the market and add liquidity to the market, it's very significant. About 40% of the average daily trading volume on the Toronto Stock Exchange comes from international participants. So that's a significant amount. In terms of southbound, this allows Canadian dealers and market participants to have low cost, effective access to the US. They can have a single, and from a back office perspective, they can keep a single book of records within Canada for both their Canadian and their US transactions. That has a significant amount of advantages. And you might think, we're talking about how do we support investment into our local economy. What I just described really is facilitating transaction and capital exodus from Canada, so to speak, to the US. But I think you have to look at it, that's in furtherance of supporting our local participants. And if our local participants can operate on a more efficient, cost-effective basis, compete with global institutions more effectively, even if that means they're facilitating or they're transacting out of the country, that makes our local economy stronger. So it might seem counterproductive that we're facilitating outward movement of capital, but it actually does really enhance the benefits for the local participant. Just give you a sense of sizing. We do about 1.4 average daily trades from Canada into to clear and settle in NSCC. So that's on a daily basis. That's a lot of activity. There are about 15,000 US ISINs that are eligible in the Canadian CSD at CDS. And again, that provides access to those securities by our local participants. So, there's a lot of benefits for those intermarket linkages, and it's something that certainly has served our market extremely well over the years. Not only from a kind of back office capital movement facilitation, but also liquidity enhancement on our secondary markets. One other aspect I'll end with is we have a significant number of securities listed on the Canadian exchange that are cross-listed or dual-listed with the US. So a issuer will be listed both on NYSE and NASDAQ, as well as the Toronto Stock Exchange. Same ISIN, same CUSIP, and with that intermarket linkage, as you can imagine, with those positions within those respective jurisdictions, those are totally fungible cross-border, and so there can be buying and selling in Canada, in US, vice versa, and it creates a lot of liquidity and capital mobility, which again I think is extremely beneficial to the local market.
Kevin, thanks. It's really, really interesting. Very comprehensive overview of what you built there, and I think that one of the things that I find fascinating is when we look at the flows of business that go across our books for all of us, is investors in many instances tend to be more comfortable investing in the countries which are close to them, physically close to them, and so Sarah, just to get your view, a different part of the world, but those CSD to CSD linkages to enable the investors to find other opportunities to invest their money. you see anything like that happening in the Middle East and in your region, and give us a reflection on what you think that might do?
Okay. Well, just recently there has been some attempts and some cooperation. We've reached a level where we have we're tending to have connections with one of the GCC countries, the capital markets there. I'm talking about Jordan, the Amman Stock Exchange, and other GCC countries to have CSD to CSD linkages. We're working on the technicalities and the legal infrastructure. As I mentioned, there are a lot of things to be done. However, it could be achieved from where we picture it now. In the Middle East, generally speaking, I do believe that there's a lot of potential, because these countries, as you mentioned, from a physical point, from a geographical point of view, they are very close to each other, and they all seem to have the same, more or less the same structure, the same setup, and even the same culture. So this is an opportunity that should be taken in the Middle East. However, in Jordan specifically, I have to say that we currently, until this CSD to CSD linkage is achieved and established, we rely a lot on our local agents, the custody and sub-custody arrangements, to provide access for foreign investors, of course, in cooperation with the CSD of Jordan. And this is where we provide all the information needed to make a more flexible and a more stable environment for the investors to come to the capital market. I have to say as well that the foreign investment in Jordan has been always fluctuating around 50% plus minus of the capital market share. And this is something that we look forward to enhancing even more. We do not have restrictions on ownership implemented to foreign investments, and we are currently working on a setup of new legislations, flexible ones, that is aimed to provide investor outreach and gain more access to the capital market. So, and of course, we will be following up on the ICSD linkages in cooperation with the Central Bank of Jordan. So hopefully all these attempts will provide for further access to foreign investments.
Yeah, thanks, Sarah. I think what I'd like to do now is just ask Attila. We've listened to all of these kind of regional or even pan-regional kind of solutions that we've all been developing to try and facilitate cross-border investment. Attila, EBRD has many functions. I think one of the principal functions you have is to help capital markets develop in developing economies. Just interested to get your thoughts on when you're advising a new market on how to bring investors in. What would be the key themes that you would talk about with that market, and where would be the most focus?
Yeah, thank you. Yes, EBRD is present in 39 countries today, from Morocco to Mongolia, from Egypt to the Baltic countries. And we see the markets from three different angles. First of all, we are, of course, as an investment bank, investors. We are also issuers on the local market in local currencies. And last but not least, we have a mandate to develop the local capital markets. And from this latter point of view, our role is to provide technical assistance to governments, policymakers, regulators, and also to other key market stakeholders like stock exchanges or CSDs, in order to improve the local ecosystem. And of course, development of the post-trading infrastructure is always a key priority, because the development of the local capital markets requires reliable clearing and settlement infrastructure first, as well as services provided by the central securities depositories and central clearing counterparties, if possible, CCPs, that ensure the safekeeping and efficient trading of securities and derivatives, and of course reduce the settlement and counterparty risks, and also supports the financial stability. This effort is also captured in our recently developed new indicator that is called the Financial Market Development Index, that aims to measure the development level of the local capital market in our countries of operation through 54 different factors. And it comprises, this index comprises two equally weighted sub-indices, The first sub-index covers 4 pillars. These are the macroeconomic conditions, legal and regulatory framework, the depth of the local investor base, and last but not least, again, the market infrastructure, focusing mainly on the post-trading issues. And the second sub-index that captures the market outcomes in terms of depth, liquidity, and diversification of markets across the different asset classes like fixed income, equities, money markets, and derivatives. But in our discussion today, of course, the most relevant is the pillar of the capital market infrastructure, and that consists of 4 factors. First of all, of course, it is the existence of a CSD or compliant central depository with the delivery versus payment, or that meets the international standards. The existence of a clearing system and risk management system, or an EMIR compliant CCP, if possible. The third point is the existence of the omnibus account system, and connecting to that, the nominee system. And the fourth one is the existence of linkages to ICSDs. And when comparing the connections between the different pillars of the FMDI index, there is a clear evidence that market depth is strongly reliant on these 2 latter factors, mainly due to the role of the international investors, of course. And it is especially true for the smaller economies, where the local investor base can have less absorption capacity. And if we take a look at the results of this FNDI index, or the outcome in different countries, we still have 10 countries among the 39 countries who don't have a really good omnibus account system with the nominee system. But if you take a look at the linkages to the ISDs, the picture is much worse, because it's almost half of these countries don't have at all any linkages to these ICSDs. So there are still many things to do. And what effect it can have on the local market, I brought today the case of the 3 Baltic countries, where the effect of increased post-trading linkages is extremely spectacular. These 3 economies have a shared stock exchange, the Nasdaq Baltic, for decades now, but the national CSDs were merged only in 2017 to form the Nasdaq CSD SE. And with highly efficient straight-through processing directly connected to the European Central Bank's Target 2 securities platform, of course. And moreover, in 2019, they established a direct link to Clearstream that further improved the market access for international investors. And as a result, the cross-border portfolio investment holdings across the 3 Baltic states have increased rapidly. In 2012, it was around $800 million. And in 2019, it increased to $3.2 billion. So that's really a significant increase due to these developments.
Thanks, Attila. I think that's really fascinating. And I think, look, I can reflect back based on our experience of when we were able to work with Ukraine and open that market up to foreign investors, that we saw, I think that, if I'm not wrong, about 50% of all foreign investment into Ukrainian government bonds ended up coming through the Clearstream channel. So it shows how important those ICSD links or cross-border links can be to bringing foreign investment across to markets. And I think, this FNDI index is fascinating because it looks not just at some of the more, expected things like regulation and legal, but, the existence of certain quite basic operational things. So Kevin, I thought I might turn to you and ask you about, in that vein, when you think about things like ISO standards and those kind of things, whether you factor those in when you're looking at cross-border linkages, and whether what the investors tell you about the importance of those kind of what might be considered quite basic operational requirements.
Yeah, I mean, it's a good point. I think I would characterize a variety of things in the general category of just, it sounds very simplistic, but it's extremely important and impactful for foreign investors in terms of reducing barriers of entry to your local jurisdiction, right? And that can mean a lot of things, and some of them are pretty table stakes, but it's extremely important. There's, I think, as you indicated off the top, Phil, that there's a finite amount of investment capital, right? That asset managers, pension funds around the world have, and they're looking at where they can deploy this capital and these investments and across the world. And when they look at cost and the value of trading in each jurisdiction, they're looking at it holistically, right? What are my execution costs? What are the costs for my relationship to my introducing broker? What are the post-trade costs, right? And so one aspect of that, reducing barriers of entry, and I think as CSDs, we all do this, I think, fairly diligently, but it's important, is understanding what the cost structure is in your jurisdiction. Not only what you're charging as a CSD to your market participant, but what's the end-to-end market cost associated with an investor investing and deploying capital and trading in your market. And without that awareness, I think you put yourself at a big disadvantage in terms of trying to respond and attract that capital. I think another area is, as you mentioned, Phil, around just adopting international standards. So ISO, SWIFT, making sure that you're speaking the language of international market participants and investors, and the extent to which your jurisdiction has quirks and nuances in terms of that communication protocol and those standards, probably the more difficult it is going to be able to attract. And we all have them. Every local jurisdiction starts in a different starting place and develops different kind of protocols and standards. But I think what we've seen over the last decade is certainly a drive towards that global standardization, and that's something we would continue encouraging. The other thing is collateral mobility. I mean, I talked about that intermarket linkage between Canada and the US in terms of more the capital and the position movement. But if you look at collateral, and as the world gets smaller and there continues to be disparate pools of collateral being managed about firms that are interacting across multiple jurisdictions. I mean, there's a variety of entities that do this very well, but being able to facilitate as a local CSD, not only collateral and efficient collateral mobility within your own jurisdiction on behalf of your market participants, but then looking outwards and seeing how you can facilitate and weave together effective and intelligent and automated collateral movements for participants across borders. And then the only other thing I would say in terms of that category about barriers of entry is, and again, this seems rather simplistic, but I think it's important, is your relationship with your central bank, right? And as an extension of that, maybe your core regulators. Like the central bank in each local market, their interests are highly aligned, right, with those of the CSD, and trying to drive towards and finding those areas of alignment and working with the central bank in a collaborative manner to bring market solutions for those common goals, I think is extremely critical and valuable. So there's a variety of things in there, and again, they seem fairly intuitive, but I think they're extremely important. And if you can do those four things very well and reduce those barriers as a local market and a local CSD, I think that goes a long way.
That's great. Thanks, Kevin. And one of the things that we've all experienced, especially those of you that are in emerging markets, I don't want to use the word emerging economies. They're not necessarily emerging economies, but certainly capital markets maturity is lower in some places relative to others, is we still see some volatility in the inflows and outflows. And certainly in the last 12 months, we've seen certain markets have had quite significant reductions in foreign investment. I'm interested in whether things like different account structures, local tax policies, availability of and transparency of market data, corporate governance practices, all these kind of things, what role they play in not just attracting, but retaining foreign investors into your market. So Ozkan, if I can turn to you and just ask you for a few examples about things that you're doing or products you're working on developing or structures you're looking at changing to ease the penetration of foreign investors into the Turkish market.
Thank you, Bill. The thing is that we are just concentrating on the omnibus account structure in Turkey to ease the penetration of the foreign investor into domestic market right now. So the other one is the dual listing. So during the panel we talk about many advantages and disadvantages of the omnibus and dual listing and depository receipt type of the flow. But the thing is that in Turkey, we understand that the omnibus account structure is going to be more popular for the investor to penetrate easily into the domestic market. So the first action is going to be take that process. The second one is we know during the pandemic we understood that account opening structure is very difficult procedures. Maybe it took over 1 month to open an foreign investor account. So because of that, we try to establish and design new electronic type of things to ease our account opening process for foreign investor in the Turkish market. On the other hand, we know the integration, especially for the corporate action type of things, XBRL type of the technical platform needs to be enhanced in order to ease our corporate informations with the foreign investors. So I know the corporate actions announcement is very difficult procedure for the local markets. When we look at the investor, the segregated account, it is not easy to receive this information, send to the final beneficiary owner of the asset. So we are trying to best how we are going to integrate with the latest technology in order to ease this process as well.
Thanks, Ozkan. Sorry, desperately trying to find my unmute button while you were coming to the end of your sentence. I think you mentioned the omnibus account. It was also mentioned by Attila when he was talking about those key factors which drive the index. Yeah. Sudeep, it's one of the things that the ICSDs have been very keen on and have actually built significant cross-border business from. And maybe you could say something about the omnibus account and your experience of working in omnibus account structures into markets like Turkey, and how you see that developing, and the importance of it in attracting the cross-border investor.
Yeah, the omnibus account is an important thing in the cross-border links, primarily because it promotes a lot of liquidity, because having an omnibus account in a market is important because it represents all the various investors able to invest through that omnibus account in the market. Now imagine that if there was every market which needed segregation and every investor having to segregate their investment in every market, then for the, let's say, 60, 70 markets where the links were there, if every investor had to segregate their, let's say, investments in all these kind of markets, they will lose all the liquidity. And as Kevin was talking about the collateral part, that gets even more complicated because the collateral liquidity has to be segregated as well. Hence the concept of the omnibus account, which provides for the pooling of the assets. And what is meant by that is that the omnibus account being there at the country level allows the investors to maintain omnibus accounts even within the ICSDs, so that by doing that, they can actually have one account by which they hold the investments, their investments in all the markets. So basically, an investor can have one account and they can hold their securities for all the markets in that single account. And that's why they have the pool of all the securities in that account, and they have the full liquidity. And that's why it's important. And on the top of the omnibus account, what is very important is to have the nominee concept in the market to provide the necessary security on those kind of assets. So essentially the fact that in case of any kind of default of the ICSDs, there is the protection of the underlying investors, that their asset is not going to go anywhere away and they get the full protection. So the asset protection is provided by the nominee, and the omnibus provides the liquidity. And this is a structure, that's why, which is maintained by the ICSDs across various markets. Now, this is a very good structure because it provides the liquidity, and this is a structure which allows for internal settlement. And what is internal settlement is that even if there is a market which is dealing with whatever kind of instruments, let's say a market is governed by its own time frame. So let's say a market is operating within these 8 hours or 9 hours of their time frame, but because the ICSDs operate almost like 24 hours during the day and evening, the investors across all the time zones, they can actually go on settling the securities across all the time zones. They don't have to depend on the market time frames, and they can actually settle within whatever currency they want to settle in because of this omnibus structure. And that is what gives the liquidity. That is the beauty of the omnibus account structure and the ICSD model. But the bottom line is that this is not the panacea for all the markets. At the end of the day, the fundamentals of the market is determined by the economic situation of the market. And what do we mean by the economic situation of the market? Last year, at the end of the year, when I was at an investors conference, all the investors, the asset managers and the investment banks, they were saying, we are going to go long on the Russian rubles next year. And we are hoping that the Turkish lira is going to stop sliding, and then we are going to all go for the Turkish lira. But right now we cannot hold the Turkish lira because it is going on sliding down, down, down, because we don't know when it is going to stop sliding. And look at what happened to the Russian ruble. I mean, nobody wants to even hold it. So because of conditions that is beyond any kind of ICSD's control or any kind of omnibus or nominee or anything like that. So that's the economics that I'm talking about, the geopolitics that is there. You can't do anything about it. Same is the situation with Turkey, for example. And here is...
I think thanks. I think that you're right. I think that, you know, we can only affect our small part of the world, and
exactly.
And I think that, you know, but that, even that being said, you know, you can see there is a direct correlation between the existence of the omnibus account and the quantity of foreign investment that comes into a market, and therefore there's a direct impact on the cost of funding for an economy if it is able to attract more foreign investment. But not only that, the omnibus account, I think, back to something that Kevin said earlier, it does facilitate the mobilization of collateral. And as soon as your government bonds become eligible as a piece of collateral, they become much more saleable in the market from a Ministry of Finance or Debt Management Office perspective. So there's a whole kind of virtuous circle that comes from this omnibus model. Although, as I would fully agree with you, that it isn't the case that you can just introduce the omnibus and it solves every problem. There's a whole series of other things outside of post-trade that need to be fixed first. We had a question from the audience, and I'm just going to, as we're coming towards the end, we've got about 4 minutes left to go before we have to bring the panel to a close. I think it's a neat way for us to draw the panel to a close. So if I could just ask you to take no more than 30 or 40 seconds each on this topic, which is, it was really about what are the most important things that you're going to be doing in your market over the next year or two in order to drive some of this foreign investment. So I'll read the question directly. What are the key milestones in the coming months, years in your local regional markets that international investors should be interested in? And then there was a second question about the impact of technology as well. So maybe if you could address both of them as one question, which I think you probably will be able to do. And I'll start with Sarah, if that's okay.
Thank you, Phil. I'll not take much of your time. Well, in Jordan, we've been working closely with the EBRD for 5 years now on a capital market roadmap development for the capital market of Jordan. There are a lot of initiatives, a lot of legal enhancements, new projects. I would say introducing new mechanisms and new services, e-services for the investors. And hopefully you'll be able to follow up all that on the websites. Not to take much long, as I mentioned, one of the major projects will be introducing and enhancing e-services for the investors. And this drives us to the second question related to the role of technology. Well, I do believe that the role of technology is highly vital currently, especially after the pandemic and everything. The reliance on the technology and the standardized data and the platforms is really important for any capital market to develop. And this is something that we keep our eyes open for. And hopefully we'll be doing a lot of enhancements in the near future. That will be announced, of course. Super.
Thank you, Sarah. Sounds exciting. And just with no more than 30 seconds each for the three gentlemen. Ozkan, if I start with you, your reflection on what's coming in Turkey?
Yeah, we are just concentrating on the technology side and the big data, the projects. On the technology side, we are trying to understand the DLT, distributed ledger technology, the platform, because this is very important. That's why I said the omnibus structure is easy to integrate with the DLT technology. If you use the segregated account, means there will be many problem in this respect. On the other side, for the big data projects, because we are the data-centric, we have a data-centric approach, so we can share all the information with the foreign customer and the foreigner with the API type of things in order to provide data to understand where are we going in Turkey as well. So right. The DLT technology, distributed ledger technology, and the big data is our coming months for projects.
And Sudeep, in 20 seconds, no more. What's on your roadmap?
Most of the markets are demanding transparency. So I think that's the main thing which we are trying to develop, and technology is playing a big role in this thing. So transparency at the trading level, settlement level, and holding level transparency. And that's coming in for the international investors. How to have transparency and at the same time maintaining the omnibus account and the liquidity at the same point of time.
Thank you. I think that's really interesting. And Kevin, you get the last word.
Yeah, I'll just take 2 seconds. In Canada, T+1 in parallel with the US, obviously a huge industry initiative across all market participants and ourselves, various stakeholders, reducing that settlement cycle. That's looking right now to take effect in 2024. On the technology side of things, I would say we're very much focused, amongst other things, in expanding our usage and accelerating our usage of cloud from a data resiliency data redundancy, and as well as to kind of accelerate and amplify our data distribution services through cloud services.
Great. Well, thank you, everybody. Thank you, fellow panelists. I think it was a great panel. We could have carried on. I think we've got another hour in us if Anna were kind enough to give it, but she's got a busy schedule ahead of her. I'm going to come back to Anna now and Anna, give you back your agenda. Thank you so much for having us.
Thank you very much as well, Philip. Thank you, dear panelists. So that has been really a very insightful, very great panel indeed. And I'm sure that it has been something that will be paving the way to some other markets, right, to pursue this road that some of you have been explaining and showcasing in your very bright examples. Thank you.
Thank you.
So
Thank you
very much.
Bye-bye.
Indeed, so now that we have this time back a bit for us, we will be able to take a short break and we'll be able to come back to you with the next panels that we have foreseen for you, very beautiful panels during which we will be discussing the global regulatory convergence. We'll be then also be hearing from the regional associations on their regional developments and hear a very insightful keynote speech from Manmohan Singh from EMF as well. So that's the plan for the second part of the day today. When we will be taking a break and returning back, my fellow colleague, Master of Ceremonies, who will be helping me to guide the conference together with me, Bruce Buttrell, the Executive Director of EXDA, will be taking the lead for the second part of the day. But we are all very excited and staying connected and in touch with you during the second part of the day as well. So looking forward to it. Enjoy your break. Do not hesitate to visit booth and see the possibilities for connecting. And of course, enjoy your cup of coffee or something nicer. Enjoy your break. So we'll speak again. We'll be back in 15 minutes, more or less. It will be 2 p.m. set Central European time. Thank you. Enjoy your break.
First and foremost, the transformation is driven by the changing needs of our clients. Our clients, in particular the banking industry, the global custodians, and many other participants in the market, continue to be under enormous cost pressure. We need to be very alert to that. I think we need to blend it with further scaling of our different deliveries, as well as to at the same time drive technology change. That's what we are very focused on. Now, all of that is clearly happening in the middle of a changing geopolitical dynamics. There are new political agendas that we need to fully account for. There is also a refragmentation occurring, which we as a post-trade industry have a particular responsibility to try to address and ensure interoperability for our clients, despite a sort of a much more complex world that it is today than it was 5 years ago. But first and foremost, technology change and the pace around it are not a sake for its own. It's always about creating additional functionalities, additional value, as well as helping to save costs for our clients. For us, the technology change means it's not only about the new and offering new areas for already advanced technology, but also ensuring interoperability. The fact that we need to connect back to the core of the systems of our clients, be it custodians, be it banks, or be it other market participants. So we are both proactive as well as very much listening to our clients when it comes to the pace of technology change. Industry events like this conference are critical. They're the only way that we get a real temperature feel, a measure of the momentum in our industry, the main change priorities that are not just individual efforts, but that are really common and a joint desire by the industry. So I look very much forward to this diverse input and therefore consolidating our views and making sure we continue to advance the broader industry context.